Yeah, you guys feeling good today? Yeah? Okay. Are your phones running out of battery yet? Okay. We're gonna try to have a lot of fun here. So, I know that you all have been nodding along for a couple of hours, trying to appear as if you understand anything that most of the people on stage are talking about. We know that you have no idea what they're talking about, okay? And so we thought that, like, as a little break in the afternoon, we'd kind of have the most kind of basic session about the actual OG real world asset, and that's real estate. This is not some kind of fake ass real world asset that was made up by a hackathon, issued, to a bunch of friends, okay, and then went up and went down as fast as it went up. Nope. This is about an asset which takes a really long time to lift, and it's almost impossible to take down, and certainly not going to take it down over a weekend. So if you want to learn about what some pioneers, some OGs, some refugees, and some recently graduated students think about probably the most solid asset class, the one that you can touch and feel, the one that has actual yield, and the one that you don't have to worry about when you go to sleep at night, then you've come to the right panel. So I'm Dave Hendricks. I'm the CEO and founder of a company called Vertalo. We're a digital transfer agent and tokenization platform, and I founded that in 2017. And I know a lot of great folks in this room, and know some of the panelists as well. And I was honored to have the opportunity to bring this topic, a topic which everybody here can understand, and to make it fun. Okay, so we've got three fantastic panelists, all the way from the edge of the stage over here. Ed Nwokedi, the CEO of RedSwan. Ed and I have known each other for years now. Okay, and
7 years, Dave.
7 years, and so this is like cycle number 3 for us. Okay, we've been through these things a couple of times, and Ed's got that kind of founder builder energy that you really, really need to persist and succeed in this industry, and this industry meaning tokenized real world assets, blockchain, distributed ledger technology, but specifically his core area of expertise, which he'll tell you about in a second. Next to Ed, you've got my new friend, John Matheson. Sorry. Look at that. I'm looking over here. John. John just flew in from the U.S. Virgin Islands under cover of darkness, private jet. Owned by an LLC, I imagine, or something like that, right? Not in your name. To come here and tell you about what he's doing with mortgage-backed securities, which is very cool, and his history. And then my new friend, my brother from my stepmother's sister, Mitch DiRaimondo. And he's going to tell you all about SteelWave and his evolution from being a bedroom entrepreneur in crypto to going to a very cushy and posh day camp in the Carolinas for college, and then emerging chrysalis, like a butterfly from a chrysalis, to take the reins of his family's firm and reimagine it. And to basically grab the brass ring and the crown away from Ed, okay, in the tokenized real estate market. So everyone, please say hello to our three panelists here. Ed, why don't you, who are you and why are you here?
That's a good question, Dave. So I'm Ed Nwokedi. I'm the founder and CEO of RedSwan CRE, and that is a blockchain real estate company that integrates real estate, debt, and equity into digital securities. We started this company in 2018, so we're about just a little over 7 years old. We've tokenized over $5 billion of high-quality real estate assets. We have a pipeline of another $4 billion. And really, I'm here because I like to educate in big numbers. I don't like to educate one-on-one anymore. It takes too much time. But if I get before our audience, I like to break it down to make it real easy for people to understand what tokenization is all about, the benefits of tokenization if you have real estate, what it can do for you, and as an investor, how you can benefit. We're focusing a lot on the next gen because they get it. They're already using technical tools like mobile apps and phones. But we think that they also begin to inherit about $84 trillion over the next 10 years. So that's kind of the base that we work with, as well as institutions that are looking to take advantage of the efficiency of blockchain technology and digital real estate. So look forward to this panel. Thanks.
So Mitch, it was great not to see you last night, but fun times today, learning all about everything you're doing. Why don't you tell everyone about your journey? It's really, your bio is very, very interesting, and it's cool the risks that you've been taking, but at the same time, you're taking that kind of risk mentality that you have into what some people think is a safe and boring kind of quadrant. It's certainly in our industry. Like how does like a guy like you get into this old guy stuff?
Yeah, I mean, I founded a crypto hedge fund in college where we traded volatility. And when we were doing that, I realized, look, we need a scalable asset class into this space. When I graduated, I went to my father, DiRaimondo, who's the founder of SteelWave. And I was like, look, you guys have been doing the same thing for about 40 years here, and you haven't changed anything on your capital stack. You haven't really innovated anything. You're going to the same, principal partners you've been going to for this entire time. Why don't we open up the door a little bit and start to bring in this next generation of wealth and technology? And that got him thinking, and we really set out to found SteelWave Digital, which for us, we really think bringing in scalable, institutional-grade private real estate will be the backbone of this next push for institutions to come into the space. The problem is SteelWave, most of our deals are pretty big. Our smallest deal is like 100 million. Our biggest is 2.5 billion. They're chunky, so that's hard to really get from the retail side. So we've stepped back and we're like, look, if we can build a product pipeline that we can then bring to secondary market over the next 18 months, we can give retail investors an opportunity which they previously wouldn't have had. So it's a two-edged sword that we're pretty excited about leading.
Is your family worried about you, or are they excited about this?
No, my dad, I think he finally thinks I'm a little bit smarter than I was in high school. But he really sees this kind of as the CMBS round 2, right? He's been through 5 market cycles doing it for so long, and he's like, look, what people don't realize is this is unlocking a lot of private invested capital that's just been sitting there. And as a developer, like, we build these really cool campuses and then we sell them. And for us, it's like, why don't we keep them and then push out those cash flows as a current yield? So when I started pitching it to him like that, it really opened his eyes, and I think he's fully embraced the space now where he sees it as the future.
That's great.
I remember when he was pitching it to his father. We were on a Zoom call in the boardroom, and his father says, I have no clue what I was talking about. And he made it simple and broke it out, and look where he is now.
Yeah, that was what, 2020, 2021, yeah. We set out, tried to tokenize a deal, and learned a lot in the process. But yeah, Ed was the one that broke it down in our boardroom originally, so thanks for that, boss.
So John, you're unlike Ed and Mitch. You didn't come to this place in this kind of regular path, right? I mean, you know, Ed was in the business, okay, and he saw the opportunities. Mitch has been in the family business. He's seen it at the dinner table, okay, and you know, right next to that. But you seemingly came at this from a totally different angle.
Oh, that's true. First of all, everything Dave said in the beginning is a lie. I've only known him less than 24 hours. So the only thing he got right was that I am a co-founder of Asset Token Ventures. We have a value coin fund that's backed by U.S. mortgage-backed securities, and we are based in the U.S. Virgin Islands. We can get into that. But it's true, a year ago, I don't think I'd ever heard the word tokenization. We were in the process of doing different types of funds, but my two co-partners, one is in the mortgage business, has been for 25 years. My other one's an international tax specialist, has his firm here in New York. And so you wrap all those things together. I'm a recovering securities attorney, and I ran a New York Stock Exchange engineering company for about 10 years. So it was a meandering route, but it's very interesting. It's very interesting what we're putting together. We just launched the fund about a month ago. We've got some good commitments, like I said, and we have, you know, with our base in the U.S. Virgin Islands. It's U.S., by the way, not British. A lot of people get that mixed up. The U.S. still owns 3 islands down there, and we are subject to all the U.S. securities laws, just like we are here in New York. So we're a U.S. company. But we are not subject to the U.S. tax laws. We have our own tax system. It's called a mirrored system, but because of that, they have programs there that offer exceptional tax incentives, and of course we're part of that. It's not easy to get qualified, but we have qualified, and so our fund itself has a 90% tax exemption, which translates into a maximum taxable rate of 2.3%. Well, if I were to found our fund here in New York, it sure wouldn't be 2.3%. It'd probably be north of 20%. Even if you move to Texas or Florida, or wherever, it's going to be more than that. So we have that distinct advantage in our yield right there, you know, with that tax advantage. So I'll stop there. Let you, Dave.
So that's a great launching off point. So you've got that tax nexus, which makes what you're doing particularly attractive to people that want to move capital into some place where they're not getting, the apple's not getting so many bites out of it, right?
Right, except, I mean, you don't have to live there, of course, to buy into the fund.
Right.
You can live wherever you want to live, but the way the fund works is the fund is the one that pays that lower tax rate, and then you choose when you want to redeem. Now, when you redeem, you'll be taxed, and if you hold it more than a year, that's long-term capital gains, so that's good for you. It's not like a typical ETF back here in the States. If I bought a mortgage-backed security ETF, I'm going to get a 1099 every year that I have to show on my tax return as ordinary income. Well, with the way we have it set up, ours is purely, you know, redemption-based, so you can choose when you want to be taxed. Or maybe if you put it through your estate planning, you're never taxed. You know, that goes into your estate and it goes on down the road.
So one of the things, if you're a real estate investor or you own real estate, like how many people in the audience here own real estate? Yeah. So if you have a mortgage, like what, you know, what's the most, you know, one of the best benefits of real estate? It's often the tax benefits, right? So if you look at your jurisdiction, so Mitch, are you guys New York domicile? What's your nexus?
So our main office is San Francisco Bay Area. Our main markets are LA, Orange County, Seattle, Denver, Austin, Phoenix, all the tech hubs, West Coast. High taxes, which is great.
Yep. And you're Texas, but anywhere, right?
Texas and around the world, correct. We're in 3 different markets. We're U.S., in Middle East, and in Africa.
So in the current kind of GP LP structures that most people invest in real estate, how much of that translates? Because, you know, everyone here, when people talk about RWA, they're not talking about growth stocks, right? They're talking mostly about yield, right? Mostly about yield. people want to, and there's collateral, there's yield, there's leverage. Like, how do you preserve those tax benefits and still tokenize and enable, like, are you able to take what real estate investors have typically looked for, both a coupon and also some tax benefits, et cetera? Are you able to translate that and use this technology?
Unfortunately not. When you tokenize commercial real estate, you're no longer a LP partnership. You're now a corporation. So you're converting your LP shares into digital stocks. So you're a security now. And so when you buy a security and sell a security, you have either a short-term or long-term capital gain. You no longer have the depreciation benefit or the 1031 roll up your profit into the next property and next property, but it does allow you now for this liquidity benefit, which allows you to get in and get out of real estate, which has been a big problem for many people. I mean, if you had to buy a piece of property like this building here, and you had one right next door, and this one gave you liquidity, and the other one did not, for the same price, you'd probably buy this one because liquidity is something that you never know when you need it. When you need it, you really need it, right? And I think that's one of the problems that commercial real estate has had for, since the beginning of time. It has not been liquid. But now it's liquid, it's tradable, and I think also it's accessible. I sold real estate with Cushman & Wakefield for 17 years and then Colliers for 2 years. And my Rolodex was really 50 big corporations. Starwood, people like that. I have an apartment building brand new. They put an offer on it. I get 5, 6 offers. I make them compete. The highest bid gets the deal. Probably many people in this room and many people in the country don't get a chance to be part of that process. So they miss out on the most pristine types of real estate in the world, the kind of real estate that Mitch and his family are building. They don't get a chance to participate on. And so we realize that people want to participate. They want to have this on their portfolio. When you look in Japan, for example, they're already tokenizing $35 billion worth of real estate. And when they issue real estate to Japanese shareholders, because they're not getting any money out of the banks in terms of interest, they're buying shares of real estate just for the ownership of the share, not even for yield, because they want to have access to these beautiful properties, knowing they're going to go up in value, knowing that they can visit it, knowing they have bragging rights at the Christmas table, they can show the people what they own. And so that's something we've missed out on. All of us have missed out on for such a long period of time. And that's one of the main reasons why I got into this business.
So that brings me to the question to Mitch, because you've got, I assume, quite a few LPs that are contributing to your capital base. One of the things that people love about tokenizing is the ability for liquidity, okay? The ability to redeem. That cuts both ways. How do you square the ability to have instant liquidity or an open market in an asset that you're trying to control? What's your approach to that?
So that's where it got interesting, and it's also the timing that comes down to it, right? So for us and the size-wise, let's say we'll go do a $100 million deal. We'll probably put 60% leverage on that when debt actually comes back in. So all of a sudden that equity piece is 40. We'll go 95.5 with one joint venture partner. So they'll have like a $35 million piece. And if they want, what they can do and what we're offering to them is going, look, can't take your whole piece, right? But take a small piece of that and bring it to secondary liquidity, and we can roll it into the next deal, right? And continue that process. And it creates almost a permanent capital lane for us, which is big. And Ed alluded to this, our deals, we're not building normal boxes, right? We're building campuses. Our main competitor now is your living room, right? We need to make all the deals amenitized. It needs to have high-end food, high-end retail, live, work, play. I think Chelsea Market's probably a good poster child example of that, right, with Hudson around and everything. So from that, it's pretty big checks that obviously take a while to do, but it's also the stuff that people want to get involved in, especially in this tech boom, right? So it's like, let's just take a Google campus, for example, right? They market around that. They want talent to come from colleges and universities to their campus. They want to market around that. Well, they also are never going to flop on their main marketing piece. It's almost like buying a piece of their debt or bond issuance. And if you can get like a 7-8% buying a piece of Google's, ownership LP stack, that's something you can put into a portfolio, especially as a retail investor. So that's where we kind of see it. Obviously, voting rights and everything get a little hairy. I think there's a lot of regulation that needs to come in and kind of set a guidelines. Also, like your mark to market, like what variables are you putting into that cost structure, right? When are you marking it to market? When can you sell? And these are the things that kind of need to come into place for real estate to exist. But I think that's going to come on as simple securities, these equities that people can wrap their head around come on chain. It'll lay the groundwork for more complicated private investment vehicles to start getting some of that liquidity.
John, what's going to go wrong with Mitch? What Mitch is doing? What do you see? What does he have to worry about?
Well, I'd just be worried about kind of making that market. How do you preserve? If you're trying to get liquidity, you got to have someone step in the shoes and be the buyer. And I don't know exactly how all that goes together. When you're tokenizing real estate, it's a timing issue, right? That'd be a question I would have.
Yeah, that's why we think you really have to own the real estate for you to tokenize it. Right? It's very hard for me to go, I want to go buy Westfield Mall in San Francisco. I need to go make an offering, bring it to open market, get pre-commitments, close, underwrite. It doesn't line up yet. That's why you kind of need to own it. And honestly, right now, 18 months ago, we were saying, recaps is the perfect thing for this space, right? LPs that want out, recap their position. I think we talked about doing a couple of our deals like that. Now the whole market's a recap, right? No one wants office. And what's happening there is your traditional players like we normally work with, they're not on the scenes right now. Their capital's on the sidelines. You say office exposure in a boardroom and you're like shunned out of the room. What that does is it opens the door for some of these high net worth sovereign wealth players to come in and buy some pretty generational building real estate that we don't see very often. So that's a win-win for us. Obviously, I think the real estate itself is the best buying opportunity I've ever seen, and I think providing the secondary liquidity around that current cash flow down the line is where it ends up. But there's a lot.
So you're saying, I'm going to get to you in a second, so you're saying that you cannot go with a lot of leverage into these situations because the problem is with the liquidity, you guys could end up upside down because you're undercapitalized to deal with redemptions. Yeah,
I mean, for this fund, it helps that the debt markets are pretty much non-existent right now, right? So we're like, look, we're going to go buy 100% cash, do 100% equity in these real estate deals. Then down the line, when rates come down, we'll probably throw some leverage on it and redeploy that back into it. But as it sits, we just think throwing debt into it is complicated. Now, that opens up the opportunity. I do think the piece of real estate that will be tokenized first is a debt offering. It might be a mezz debt, might be whatever you want to call it, but it's just going to be
not the equity.
Yeah, exactly. Yeah. It's just a consistent cash flow, right? Yep. It's something you can underwrite. You could even call it a stable coin if you wanted to, right? And that's where you can start getting regulators thinking, wow, well, if we're underwriting debt in this building, it's a construction loan, why wouldn't we want to bring that at an 8% current? So, what are your investors thinking about all this then?
Well, investors are thinking about yield. That's really what what they're focused on. Some of our investors are major institutions, like I said, international financial institutions looking to borrow at a low cost, like in Singapore and Japan. They can borrow at 1.5%. They can bring it here because our interest rates are higher. They can invest at 7%, 8%, and so the arbitrage is pretty good. They can also, if digitize, take those shares that they just invested in and sell it to the retail market. And even if they sold it to them for 2.5%, in places like Japan, they're very excited. But I think one of the main benefits for property owners is that, maybe not Mitch, because I think they are learning to build and hold their properties. But if you build beautiful assets like what his family is building and others like CIM, It's a shame that they can't hold those assets long term. The way the system's built is they get financed. He talked about the capital stack where he's putting in 5% as a developer, and 35% is coming from other equity investors. They pretty much control the deal, the equity investors, in most cases.
Yeah.
And when they want to exit, they make them exit, right? I was the one that they called up to say, sell it, because our equity guys want to get out. We would rather stay for a little while and build up more value, but they're forced to get out. I think if everyone understood who owns real estate how tokenization can help them, they would never have to sell their asset. They would always be able to be the GP over the asset, and now you have zero equity in your property, but you're now getting cash flow in your waterfall perpetually every single year from that asset performing. So I think that's where things are headed. It's just a matter of the owners getting educated to that fact. They'll never sell. And that means it's going to disrupt a lot of industries. Look at my industry at Cushman Wakefield. I sold, we sell $70 billion a year worth of assets. If more assets get put on chain and become shares, and you don't have a license to sell those assets, you're not going to be selling 70 billion anymore, and the industry is not going to be selling $1 trillion a year. It's going to get reduced and reduced and reduced. So things are happening and they're changing. I think it's changing very quickly. But bottom line is, hold assets long term because you can't manufacture land.
I think what Ed's talking about is bang on right. There's something in real estate called your core assets, right? And you put them on the balance sheet, you don't move them. Like BlackRock, Vanguard, they got a bunch of them. And candidly, they are the ones that are sitting on this gold mine, and they have no idea that this technology exists. And the minute they do, I mean, the products that are going to be coming into the space are just going to be flooded. But again, it happens slowly until it doesn't, and then it's logarithmic, right? And I think we're seeing that.
It's like waste energy fueling Bitcoin, stranded collateral, right? So your thing is collateral, right? You're like that. Now, let's talk about the utility for what you're creating. So someone invests in this CMBS, in these mortgage-backed securities that you're doing. Everyone here has been talking, like the other panel has been talking about, like, what's the use case? What's the utility? How do I get leverage from this thing? So I just don't want this just to have this token. Because right now, if you just tokenize this stuff, it's like, okay, great, it's on a ledger. Like, what do I do with it? Okay, it's cool. It's a great record-keeping technology. And as a transfer agent, I create distributed ledger record-keeping capabilities to produce tokens. I'm fine with that. But the audience, the people in this room, and many of the investors want to get further leverage. They want to be able to use this. What are you thinking, John, about when you create this token? Is there another extension use of it? Would you allow that token to be pledged elsewhere to get more leverage? And how would you do that?
Yeah, that would be, I mean, right now we're a traditional fund, Reg D, Reg S fund. We're exempt under the 40 Act, and so we couldn't go down that path. There may be an ability to put in a line of some sort. Someone could pledge, a margin basically for whatever tokens they have and get some liquidity that way without having to redeem. They can redeem anytime they want to. They can buy today and redeem tomorrow, and we'll burn their tokens. But we are trying to investigate other ways for there be more liquidity put in. If they were able to have a line or something like that. But so far, at least where we are today with this fund, we haven't solved that.
Mm-hmm.
I think taking it a step farther, what we're seeing with leverage, and you're talking about this, and Ed and I were on a panel last week, and this is a big topic of discussion. What we're seeing, especially at our scale, is you have a lot of these early Bitcoin adopters, right? That'll never sell their coin because the tax is just ridiculous, right? They believe in it, max, whatever, right? But they can go to a bank and get a loan against it, right? And then they take that loan and they'll dump it into a group like us to go buy cash-bearing real estate, right? They'll pay off the loan value, they'll pocket the rest. Over time, as the real estate goes up in value or the Bitcoin goes up in value, you pay off that loan. That's where it starts to get interesting, and I think.
Are you taking payment in anything other than Bitcoin right now? Will you accept that? And is there a discount if someone pays in something like that?
So we'll only take dollars right now.
You only take
only
dollars.
take dollars. But we work with a couple banks that do some pretty interesting lending options that will take a position and then make it so that we can go deploy it on the real estate side of stuff. And candidly, it's no different than a traditional LP piece. It's just, it's backed by a next generation asset.
You know, I'm looking forward to seeing more real estate becoming into the DeFi realm because I think it makes more sense than anything else. You think about DeFi right now with cryptocurrency, Bitcoin, they have to price it a certain way to cover the risk. Bitcoin, which is the strongest cryptocurrency, bounces up and down on a regular basis, and sometimes those are 10, 15% swings. If you hit 100,000 on your Bitcoin and you borrow, you know, even 25, you hit Bitcoin hits 100,000, you borrow, and you have 100 million Bitcoin, and you borrow 25 million from your Bitcoin at that point, and you invested it in 5 real estate assets that are generating 8% yield. Whoever's doing the DeFi on that Bitcoin is worried about the Bitcoin falling in value. That's why they're charging maybe 9, 10, 15% interest. But if the person who borrowed that $25 million and bought some of our real estate skyscrapers in New York City, for example, or in Houston, they can lock that $100,000 Bitcoin value right there on that real estate for that $25 million allocation. It's paying them 8% yield on a regular basis, which is covering the cost of their borrowing on the Bitcoin. If there's an arbitrage where the Bitcoin borrowing is at 6%, that's 2% more they can use to buy more Bitcoin if that's what they love. But it just makes so much sense to continue to protect your crypto investment and balance it out with something real, stable, that is also appreciating in value and generating income at the same time. So I think, again, it's just about knowledge. Once people really understand what's out there, what they can do with it, I think that everyone's going to change and move in that direction, which is why for the past 7 years, our focus has just been putting high-quality assets on chain. Just because eventually the bank's going to figure this out, the Bitcoin finance is going to figure this out, and they're going to look for the best quality real estate in order to do this with.
Which chain?
Good question. So we use a couple chains right now. We like Stellar, we like Hedera. Both of those chains because they're very strong on real RWA. They're educating their users on how to look at RWA to grow wealth.
Does it matter?
Pardon me?
Does it matter what chain?
It doesn't. I mean, for me, it matters because I have to sell the chain to the sponsor. And you know, in case of like Hedera, they have a corporate council, governance council that has all these major institutions who are kind of governing the ecosystem.
Should it matter to the investor?
It does matter. Should it matter to the investor? I think so. I think that where their chain is actively doing business around the world is better than a chain that's just doing business in one country, for example. So I think a global approach is better because it gives us more of a global approach for customers on the content real estate side as well as on the investor base side. It gives us better reach in terms of Reg S investors, international investors we can sell to with very few restrictions with regards to SEC versus US investors have to be accredited investors unless we did something like a Reg A. So yeah, it matters with chain.
So Mitch, we were talking about this before about foreign investment and those other elements. So one, do you care about chains, and do you see these assets being bridged to be cross-border?
So for us, and what I've been saying is, I don't think the chain or the technology that's going to be the backbone has actually played its cards yet. And the reason I say that is because with our scale, we kind of see a lot of this conversation, and we're like, look, there's a lot of room to grow here. And I think there needs to be innovation, but also regulation that comes into this space.
You're not giving me an answer there. Come on, stop.
I mean,
What's
for
the
us,
answer?
internationally, I would say it doesn't really matter for our investors.
So a chain doesn't matter.
For our investors, they're coming into this because they want the real estate exposure. The liquidity on the back end is a plus for them, but they're underwriting us for the deals.
Are you getting paid by a chain? Are you getting paid by a chain?
No, not yet. So, yeah.
No, you're not. You don't have the jersey on.
Yeah. No, I mean, look, for us, Ed said it right. We know this is coming. It's a wave.
What chain do you use?
We're trying to just.
I'm not going to stop until you give a straight answer.
Well, we haven't even tokenized anything really yet because we've just been building the portfolio.
What chain would you use if you were?
Right now?
Yes.
I'd probably Solana. I like the team.
Probably Solana.
Yeah.
Solana's here. Did you guys get this? You got to tag him up, okay? The price is low in Solana right now. It's on sale.
I know.
Okay?
Black Friday price.
Yeah, I think it's going to go down some more though, so don't worry about that. I would wait. Okay? Make sure,
But I mean,
sell some puts.
for institutions to play, and I think the one thing that needs to be stressed here, for institutional money to play, institutions need institutional grade assets.
Okay, we're moving on. Next, John, we don't have any time for that. We already have a lot of blah, blah, blah on the other panels. We got to have the straight answers on this panel. So you're new to this. Like, do you even know what chains are?
We do have a chain.
You have a chain. Did you chain shop before you decided to do this, or
Yeah, I
did someone
think so,
tell you what to
yeah.
use?
We have Aptos, but I mean, this is our first fund, and we'll always, keep those conversations open with all
You're
people.
chain curious?
Yeah, absolutely. We'll see what's best, what's cheapest, and what's fastest, and
Yeah.
we'll make that decision every time we put a new fund.
What chain should John use? Oh God, are you guys dead? Come on, snap it up. Come on, who's got the funkiest chain? Who's got the weirdest thing that no one uses? Oh boy. Okay, we tried.
I got no
We did.
jersey coming.
We got 3 minutes to see if we can resuscitate the patient. Okay. So you're still looking at this, right? It's an interesting conversation,
Well,
right?
I think, if you're going to talk about which chains to use, figure out which chain, if you're talking about real estate, which chains have the most real estate on chain, which will have the most eyeballs looking at real estate is how I look at it.
Is that for the chain or is that for the trading venues? Because I would,
It's both. I mean, if the
yeah.
chain has it, their ecosystem is going to know it has it, and they're going to be after it, right? And so I think visibility is very important. Many people don't know what's on chain. Many people don't know what kind of product's been tokenized. And if they know it's been tokenized, they know they have an opportunity to buy a fractional share of it. But if it's not there, you go to Binance, where are you going to find real estate on Binance? You'll be looking at all kinds of crypto, but you'll never find real estate. But if a chain advertises that they have real estate as a category on their platform, a lot of eyeballs are going to go there.
So you think that's because there's TVL on chain and therefore it's
Exactly.
stronger, et cetera, and then maybe there's more transactions? Exactly. So I mean, but for the chains that are making money from fees, right? Ideally, your stuff doesn't transact that much.
Well, that's important. You don't want to have a chain that's going to cost a lot of money to process, right? It was one reason why we left Ethereum a long time ago is because the cost to process was too expensive, not for the U.S., but for overseas investors who may be buying $500 allocation, and that fee for them is $65 for gas fees. That just doesn't make sense when it can be more like 6 cents.
Okay, fast forward a couple of years and there's no more like fiat or anything like that, and you're getting paid all in crypto. Are you guys going to set up trading desks, or how do you deal with this stuff once the people start investing in things other than USD or
We
euros?
take stable coins, right? So
Yeah.
they can deposit stable coins in our Coinbase account, then we can credit their account. So,
Yeah.
But we don't take crypto because we don't want to take a exchange risk.
Stable coins aren't crypto?
Pardon me?
Stable coins aren't crypto?
They are crypto, but they're stable because they're backed
You mean
by
like
dollars.
USDC? You take like
USDC.
USDC, USDT, and that sort
USDC
of thing.
primarily.
Okay, cool. So in finishing up here, we got 90 seconds. Where can people find you, Ed, to learn more about what you're doing?
Well, I'd like them to go to our website to see our opportunities at RedSwan.io. But if you want to find me, I mostly respond to LinkedIn. That's at Nwokedi. Just put Ed Nwokedi on LinkedIn and you'll find me.
Great. Mitch, where are you, man? I know where you are, but I'm not going to tell them.
Yeah, Twitter is probably the best way for me. I'm on there a bunch, Twitter and LinkedIn. But yeah, if you look up SteelWave, just the website, you can kind of see our portfolio. And the real estate we have on there, it's not normal real estate. And that's the type of product I think the space needs. So that's good spot to start
Great.
looking.
Go to SteelWave. Okay, John, where can they find you?
I'd say the easiest way is LinkedIn. I mean, just look at Asset Token Ventures. We have our own page. All of our stuff's on that. Also, of course, our website. If you want to go directly to that, to invest in the fund itself, atvfund.io. That'd be the great place.
That's great. Hey, thanks, panelists. Great job. That was a lot of fun. Hope you all enjoyed the panel this afternoon. And make sure to check out these guys are building real stuff around real-world assets and generating yield and moving to the future together with you all. Thanks so much, everyone.
Thank
Thanks,
you.
Dave.